Welcome, everybody, friends and clients. Thank you very much for joining us this afternoon for our September town hall. Today's town hall is, I think, a particularly appropriate and interesting one, given that the market has been pretty crazy this year. Today, we're at all-time highs, but just a few months ago, we were down 15% on the S&P 500. You know, when you have those kinds of extremes from high to low and then back to high, it can really mess with one's emotions, and particularly when the narrative in the financial and national media is one generally of doom and gloom. It's really hard to learn to become a successful investor. Well, our job at IWA in part is just to do that, help you understand the markets, but more importantly, understand how to deal with the wild swings, both up and down. And so today, our theme, as you can see there, behavioral investing. Let's look at our agenda to start things off. First of all, we're going to answer the question, why do investors make mistakes? These are not mistakes of analyzing a company or an index or a mutual fund or ETF. This is, again, allowing emotion to influence decisions we may make on a day-to-day, week-to-week, or month-to-month basis. We'll cover a Vanguard study that came out way back in, I believe it was 2019, I believe, is when it initially came out. It's been updated recently. You'll find that very interesting, some interesting statistics there. We'll have some anecdotes along the way throughout from successful investors that we think will be very beneficial as well. And we'll talk about our current thinking. And in fact, we'll look at this market this year and maybe give some life to some of the things that we're going to be talking about, some practical analysis of behavioral investing as we go through that. And then we'll do a quick market recap. As we mentioned, we're at all-time highs, pretty remarkable after everything we've been through this year in the financial markets. All right, let's get into this and let's answer the question. Why do investors make bad decisions? And I titled this, Why Do Smart Investors Make Bad Decisions? Because, you know, you're all smart out there. Oh, you may say you don't know a lot about investing, but you're smart. The answer to that question is smart has very little to do with it. So we're gonna answer. We're gonna go into why that is. First of all, we're all kind of wired the same way. We have that fight or flight mentality. If we're threatened, we automatically, our brain shuts down and the adrenaline rushes out to the extremities and the heart, and we're able to either flee or we're able to defend. That's the way we were built. So loss aversion and all of the things that we're going to be talking about here are things endemic to every single one of us. It's in our wiring. And this first one is very interesting, loss aversion. And note this comment here. It's more, and would you agree with this? It's more painful to lose money than there is the joy in making money. Interesting. So we all want our accounts to go up and we feel really good about that. That is an emotion. That's a high. But that low of seeing red in our accounts, a sudden drop in the market and in our account balances. It's interesting. A study was done in the book entitled The Psychology of Investing. It showed that it is twice as painful to lose money as it is to have the euphoric feeling of making money. Would you agree with that? Personally, I disagree with that wholeheartedly. I actually think it's much more than 2 times. And that's why typically when the markets are down and when your account is down, you're looking at your losers and saying, my goodness, shouldn't we get rid of these losers? And so that's one reason smart people make bad decisions. And then, of course, there's the herd mentality. Everybody else is doing this. The market's down. Your coworkers are talking about their 401k plan around the break room table. And one of them who knows everything about the market, maybe he's older than the rest, and he says to everybody, well, I got out or I'm getting out. Well, what do? You follow that lead. That's the herd mentality. And, you know, that works the other way as well. You know, we'll take a look at this next point here, overconfidence. You know, we tend to think about behavioral investing and preventing mistakes when the market is down. And that is absolutely true. And that's the vast majority of where investors make mistakes. But you can also become very overconfident. Maybe there's a hot stock or a hot sector, and it just goes up and up and up. And pretty soon everybody's talking about it. Will that lead you to join that herd mentality? And in this case, a herd mentality that is overconfident. Yes, overconfidence is a big mistake that even smart investors can make. It leads to excessive risk taking when everybody else is optimistic. So again, that's an extension of that herd mentality. All right, and then of course there's the aforementioned fight or flight. As we mentioned, we're wired to make impulsive decisions when faced with fearful conditions, and again, that's a huge mistake. Yes, it's good for fleeing an altercation or defending ourselves against an attack, but it's not very good when we're in that emotional state and we're called on to make an intelligent investment decision. There's been studies biologically, the decision-making part of our brain shuts down and it just goes into that fight or flight mentality. And when we're in that condition, again, as we mentioned, very, very bad position to be in to make smart investment decisions. And so these are the basic reasons why people make bad decisions. Let's take a look at this visually, though. I think this next slide is really interesting. Take a look at that. See if you haven't felt this way yourself from one time or another. I know I have. We're all wired the same way. You can see on the far left there's optimism, the market's going up, and then there's excitement, there's thrill. And then finally, at the very top of the market, there's that old term euphoria. It's different this time. This time, the market's going to keep going up. I remember back in 2000 when we had the dot-com bubble crash. The market had gone up for 5 straight years. And people who were smart, economists, portfolio managers that value these companies were actually getting on the financial media, and they were saying with a straight face, this time it's different. The market will keep going up. Well, obviously the market crashed, and you can see that's what happens here. Market starts falling, anxiety, denial, and fear start to come in, and then depression gives way to panic. And then finally, at the bottom of all markets, when they finally bottom, and that last person sells, when everybody starts dumping and there's blood in the streets, those kinds of things, you have capitulation and despondency. And then, of course, the cycle starts all over again. Okay. Remember, we mentioned too that the joy of gain, this euphoria here, is halved by the pain of loss. This chart was not designed to prove that point, but you can see the high here isn't as high as the low is here on the other side of the spectrum. So again, really valuable information, and it does give way to the great Warren Buffett. Here's an anecdote that we referred to before. And if you want to know the answer to what makes a successful investor, let's read this together. The stock market, as he says, is a device to transfer money from the impatient to the patient. Real simple, but so true. If you are patient, you will be just fine. The problem is it's hard to be patient. Let's explore that practically by looking at a slide that we've been sharing for the last several months. Ever since we had the big crash on back in April, where the market fell significantly, and you can see that right up here. That was the tariff tantrum. It wound up being a 20% drop. But take a look over the last 10 years. We've had 4 other 10% or more drops. In fact, we had the 40% drop there in COVID. What's interesting in your mind's eye about this chart? Well, there may be several things. Let's go back in time. Let's go all the way back to 2016 when Trump 1.0 started. He got in office. One of the first things he did was put on a 25% tariff on China. Market dropped. You can see here, it doesn't seem like a big deal, but it was a very big deal then. And you can see the market was at a high here. got down here to a low. And of course, there was a lot of fear that, my goodness, here's a guy that's going to start putting on tariffs. We haven't had tariffs for 50 or 60 years. What's that going to do to earnings? What's that going to do to inflation? I mean, all of those things. Oh, yes, all of those things that we've been hearing this year. You can see what happened. The market rebounded almost as quickly as it went down, just a very, very short period from high to low to high. And then, of course, the market does what the market always does after a big drop. It goes on a nice run, and we saw that there. But in each of these situations, 2018, the Fed was raising rates. There was a 20% drop. My goodness, in 2020, there was COVID, a 40% drop in a month, in 1 month. Who in their right mind would be investing at that particular point in time? And then, of course, the very painful long-term decline in the stock market back in 2022 when Jerome Powell, our Fed chairman, was raising rates aggressively and rapidly. You saw that big decline there. And then, of course, right back to the tariff tantrums. And so you can see a lot of people clearly were selling on the way down. And the question is, when do they get back in? Right? That's the thing. And so here's another anecdote that we wanted to share with people, that this chart here, and I want you to try to keep this in your mind's eye. I'm happy to send it to you upon request. Just shoot me an email. We'll be happy to do that. It's something you can put up on your refrigerator or right over your bed and look at it and learn from it on a regular basis to be patient in the market. But again, all of these downdrafts, people will say, well, we should have seen that coming. Well, is that really true? Should we ever see a big drop coming? Yeah, it's kind of like when you go outside and the sky is blue, you don't see anything coming. But, maybe you go back in the office and a couple of hours later, you walk out and there's storm clouds. Well, something's going on. So, yeah, you might take some action. But the reality of it is these things are unpredictable. The markets are all by themselves volatile. That is the nature of the game. That's why we call it investing and not saving. Banks and CDs, that's saving. FDIC insured, short-term needs, etc. In stock market is investing longer term, but higher returns. But the price tag to that is, of course, volatility. So let's enjoy another anecdote from a famous investor. You may remember the name Peter Lynch. He was famous back in the 80s, 90s, and early 2000s. He ran the gigantic, at the time, Fidelity Magellan Fund. Notice what he said here, and this answers a question that I hear from a lot of investors, particularly today. And I think it's important that we insert this in this presentation, because the question that I've been getting is this: I've heard a recession is on the way. Should we move to the sidelines? And of course, there's a variety of additional comments that are made there. And then we can get back in when it's safe. Well, my question to you all out there in the audience, when is safe? Is safe when the market moves back up to all-time highs, or is safe when the market starts to settle down and then moves up a little bit? Is that the safe that is meant? Well, we know that none of us really know, because the market, quite frankly, from a day-to-day standpoint, from a short-term standpoint, it's never safe. It's not safe today. If you need money a week from now, it's not safe to put the money in the stock market. But if you need the money 3, 4, 5 years from now, then yeah, it's probably safe today, even at all-time highs. And I would also argue, going right back to this former slide here, when the market was down, even though we did not know what the bottom was, none of us are going to know. But if you were buying down here at all of these lows, even if the market would have kept going down, that would have been safer, arguably, than it would be at an all-time high. So again, it's just that wiring, it's that thinking that we want to change. And we go back to Peter Lynch, the former manager of that very successful fund back in the 80s and 90s. He said, look, don't try to time the market. You're not going to time a recession. Look what he says. He says, far more money has been lost by investors trying to anticipate corrections or recessions than lost in the corrections themselves. Would you agree with that? Um, I kind of do. And I'll tell you why. I'm going to refer you to a study that was done back between 1982 and 1999. Now, 1982, I know is a long time ago, but it ushered in the greatest bull market we've ever seen in this country. 82 to 99, the stock market averaged roughly 16% return a year. I mean, that's mind blowing money. $100,000 in almost 20 years, 16% a year. Do the math. That grows to in an enormous amount of wealth. Um, so the question that I heard one presenter ask one day is, well, if the market made 16% from 1982 to 1999, why wasn't everybody driving a Bentley? Okay. The reason was because the average individual do-it-yourself investor's return was a measly 3% a year. Why do you suppose that was? Well, I would argue, let's go right back here, that when Trump went into office and announced those tariffs back in 2016 and the market fell 10% and it was an unknown. I mean, it was right to be afraid. We're not saying fear was wrong. We're saying don't let fear govern your investment decisions. Um, I'm sure a lot of people sold down here at the bottom, and I'm sure they didn't get in the next day when it started moving back up again. Why? Because, well, you turn on the financial media, you're always going to hear a guy say, the market just had a 10% drop or a 20% drop. It's got to retest the lows. Does the market ever really retest its lows? I mean, look at these 10 years. Were any of these lows made after the recovery ever retested? No, not at all. So again, listening to media, listening to economists' predictions. I should have thrown up another anecdote. One of Warren Buffett's anecdotes was the reason we have economists making predictions because they're so bad at coming true is to make fortune tellers look respectable. So I mean, it's a remarkable thing, this idea of trying to time the market. It just doesn't work. And so Peter Lynch's words here: far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves, is historically accurate. Okay. And so bear that in mind. We think that's a valuable slogan to remember. Okay. So let's turn our attention now to some practices that might help you and I become better investors, to help you and I look at downturns as opportunities as opposed to reasons to get out, and to take advantage, to act more successfully as an investor. And look, we know we're managing your money. We're not saying, oh, you're going to do it yourself. But boy, it really does help you sleep better when you think more like a Warren Buffett or a Peter Lynch or so many of these other really good investors out there. So let's take a look at this. Practices to overcome emotional investing. I put this first one in here myself because I apply it to myself. I look myself in the mirror and say, hey, am I really able to handle this level of risk? Maybe not. So if we know ourselves, why put ourselves in that kind of corner in the very first place? So having an honest conversation about what kind of risk we're really willing to take. Are we doing this just because somebody at work made a ton of money in Bitcoin or some XYZ stock? If that's the case, then that's not a real sound fundamental reason to get into the market or to buy a particular XYZ stock or some other kind of more risky long-term asset. That will only lead to emotions rising, and we know what happens then. We make mistakes. The other question I think practice is to know where you are in the stream of time. I mean, if we're 5 years away from retirement, should we have 100% of our money in stocks? Probably not. If we're 30 years old, though, and we are gainfully employed, should we be very aggressive and be all S&P 500, for example, or small and mid cap or international, I would argue that history is way on your side. Set it and forget it, as they say. So knowing where you are in the stream of time, not thinking, oh my goodness, I lost a ton of money over here a few years ago, I've got to make it up. Well, wait a minute. You've got enough today, all right, to be okay for the rest of your life financially. Why mess with that? Yeah, part of that'll be in the market. And these things that we're talking about today will help you with that part that is in the market. Okay. This other one here is really important. I think people get themselves into trouble when they're all in. Short-term needs come up, emergencies happen, kids have to go to college, or the garage door needs fixing, or whatever other emergency that may come up. And it's a sad statistic. The average American doesn't have hardly any money in emergency funds. And so our view is, when we're talking to clients and sitting down and doing their plan, we're making sure that they have a reserve always in some kind of cash-like investment. We don't care what the return on their money is in that investment. We care about the return of their money, and more importantly, when they need it the most. That could be next week, next month, and that money should not be in the market. So you think about it for a moment. If you have a reserve, if you have plenty of cash that is available to you to get you through a scenario, it's going to be a lot easier to deal with a negative scenario. All right. If back in April, when Trump, on April 2nd, out there in the Rose Garden, and he held up those placards with all those wild tariffs and all those trading partners of ours, and the market fell literally 15% in the next 3 days. Yeah, that's painful. But if you have your immediate needs cared for, and that short-term need for money a month from now that you're going to spend is not in the market, boy, you feel great about yourself, don't you? It'll allow you to get through that temporary trauma of whatever it is the market is throwing at you in that particular day. Okay. All right. Here's another good one. A diversified portfolio will help endure downturns. Again, it's part of knowing where you are in the stream of time. If you're getting ready to stop working and earning an income, all you've got is what you've got. And that pot has to produce enough income to secure your lifestyle that you worked hard to enjoy for the last 40 years or so. So having a diversified portfolio is extremely important. I know that is an overused term, and it's a very used term, but it is quite true. If you have enough money in safer, secure investments that are producing income, not only are your income needs going to be addressed, but let's say you got a 70% income portfolio and a 30% stock portfolio. And then all of a sudden we have a month like April of this year where the market falls 15%. What do you get to do? I mean, you get to be Warren Buffett. I mean, Warren Buffett loves downturns in the market because he always has income-oriented investments. He has plenty of cash sitting on the side that he's able to convert some of it over into the stock market and take advantage of other people's impatience and emotions. And so the diversified portfolio is good for so many reasons. And again, this is where we come in. This is where we can help you a lot. And I believe that we have in that area. All right. Be careful with economic and market forecasts. I kind of jumped the gun a little bit there and talked about that, but most economic predictions are wildly wrong. They are meant to be short term. God bless them. These people are employed and they draw paychecks. And to a certain extent, I would argue and agree that they're needed. But they're needed for other reasons. They are not needed for you and I watching them on television and hearing, one proclamation of doom with another proclamation of excess. Really relying on fundamentals and trying your best to be a long-term investor, a patient investor is what's going to cause you to be successful. And again, that's something you hear over and over and over again. And I know some might be saying, well, Steve, we know you. You're optimistic. You're always optimistic. I'm going to talk about that for a minute. There are fact-based reasons for any advisor to be optimistic and to keep you in the market. We're going to discuss those here in a moment. And as a matter of fact, let's start to do that right now. I think the other practice to overcome emotional investing is just that. Trust your advisor, whether that's us or somebody else. You have a relationship with an advisor, talk to them, meet with them, make them explain your investments to you as you know that we do. You know, they should have a good understanding of what's going on in the overall economy. I mean, after all, we're not suggesting for a minute that you should just put your money in the market and never look at it again. You should understand what's going on so that when the market does fall, you understand why. That in and of itself can help one to make it through that particular period of time. And more importantly, to take advantage of it, which is what we're really good at and what we've helped our clients do for many, many, many years. Market goes down, we're not afraid to go buy high quality investments to take advantage of that. All right, so let's take a look at this Vanguard study. We talked about that in the opening agenda. It's actually called The Value of an Advisor. We're happy to send it to you upon request. Send me an email or a note, and we will get this report to you. We're working on our website right now. It's actually going to be on our website probably in a month or two, but if you want it now, we'll be happy to email it to you. So just send us a note. It could be me, Steve at iwaplan.com, or whoever your advisor is that you work here. It could be Lainey or Doug. Please reach out to them and they will get that study to you. So let's talk a little bit about this study. What does it reveal? Interesting. Basically, after a whole bunch of pages, which I think it's like 20 or 30 pages of analysis, they come up with this statistic that advisors add about a 3% annual net additional return. And how do they do that? Well, portfolio rebalancing. So let's say you've got that 70-30 portfolio and the market's been running like crazy. And now all of a sudden it's a 60-40 portfolio. Well, we rebalance the portfolio. It's called discipline. And you know, that's good because you're selling high. All right. And the converse of that is true also. If you have a big downturn in the market and you were 70-30, now you're 80-20. What does that automatic rebalancing do? Well, it forces the advisor to buy low. That's a smart practice. That's a practice that good advisors follow. So portfolio rebalancing, also spending and withdrawal strategies. Where, you know, when you need income, which vehicle do we take it from? That will make a difference too. Same thing with tax efficiency. I mean, are we going to sell something that's going to create a taxable event, or is there something we're able to access that will minimize or eliminate any kind of income tax on that particular withdrawal? So that's part of it. And then as we continue on here, this is the number one thing though. Number one is walking you all off the ledge into the loving arms of your welcoming advisor, okay, with his fireman's hat on, okay? He's saving you. That's what this is right here. He's coaching. We're coaching you, but this behavioral coaching, keeping you in that allocation, all right? So let's say it's 70 income, 30 stocks. We're keeping you in that 30 stocks, okay? If it falls to 20, we're buying more. We're keeping you in there. We're not going to press the sell button and get out of it because we don't like who's president, or we don't like what's going on in some country over, you know, thousands of miles away. We don't pay attention to that. Doesn't mean we don't look at fundamentals. We do. And we're very excited about some of the fundamentals that we're going to share with you here in a moment. But very interesting study. If you'd like it, let us know and we'll send you the detail out to you. But this is a big value add that advisors will help. And I would argue, I mentioned the period of time. from 1982 to 1999, where the S&P made 16. Okay. The average investor did 3. I mean, it could be more than 3% a year, but Vanguard says 3. I'll take that. I think that's evidence enough in the advantage of working with someone who's going to help you work through and live through these very difficult times, not only at the bottom of markets, but sometimes even when everybody's overconfident, and maybe you get a little bit of that overconfidence as well. All right, finally, and I've alluded to this, it actually pays to be optimistic. Think about it for a second. Optimism. Optimism doesn't mean someone's not realistic. It just means they look at the situation positively. You know, in every situation, there's a positive way to look at things and a negative way to look at things. And I would argue, you know, you think about a guy like an inventor like Thomas Edison or any other great inventor. If they were pessimists, would we have advancement? Would we have innovation? I hardly think so. You know, I think when you are given a set of facts about the United States financial markets over now, I mean, 150-year history, and those facts are very clear about what typically happens in up and down markets. It's easy to be optimistic when you have that arsenal of history in your satchel. Let's take a look at this. Here's one broad example. This is the Dow Jones Industrials going all the way back to the 1870s. All right. A dollar down here to the lower right, $1 turned into $32,000. And I think this is like through 2019 or something. Amazing. Pretty remarkable when you think about that. And yeah, it's very easy to look at all the downturns. There are several of them. You can see here, this is the Great Depression, okay, in 1929, the largest decline, the worst and longest bear market ever. But look, it recovered. I think one could argue that it's one great big long bull market. So we have the advantage of history on our side. And I would argue too, you know, from 1870 all the way through 2020 on this 150 years, a lot of bad things happened. I mean, you had the Great Depression, you had 2 world wars, you've had not one now, but 2 pandemics over that period of time. And then, of course, you know, a mere hundreds of other geopolitical issues, which aren't even mentioned on this particular slide. So this is kind of exhibit A. How about another reason for you to be optimistic and why I'm optimistic when markets are in trouble and all seems lost, and it does seem different this time, even though it's not, is this chart right here. Take a look at this. Odds of winning in the market. Now, what this is a study going from 1901 to 2023 of rolling 1 year, 3 year, 5 year, 10 year, and 15-year returns. This is the reason why I'm optimistic. The advisors here at Integrity Wealth Advisors are optimistic. Yeah, we love to understand the economy. We do care about the downturns. We particularly care about the reasons for them. This year, when the market was down 15%, who in their right mind, and I'll be honest, I would have never thought back on April 7th that the S&P 500 would be up 11% today after that decline. Minus 15 to plus 11 in what? 4 months? 5 months? Pretty remarkable. It shows you how quickly it can happen. Sadly, I know a lot of investors that got out and didn't get back in. And I would imagine there's a lot of folks out there that you may know that got out and never got back in because of the fear, because of the emotion, because it's all about our behavior in investing. All right. So I'm going to give you some recommended reading here as we begin to wind down, and then we're going to take a look at right now, why are we optimistic today? We think there are some valid reasons, but people are always asking me, how can I become a better investor? So here's some recommended reading. You can Google these things and order them. Many of you have the book, The Psychology of Investing, because we've been giving it out. We've been giving it out for the last couple of years. Morgan Housel psychologist, excellent speaker. You might also Google his name and the name of the book. He's got a great podcast you can listen to and sign up for. I would highly recommend it. If you go to davisfunds.com, there's a series of video interviews that you can watch as well. We would recommend that. The other book that we like is Stocks for the Long Run. That chart didn't come from the book, that 150-year chart, but Dr. Siegel, he's the professor at Wharton, he goes back 150 years and very methodically, mechanically, and factually represents that stocks are the best place to make money. But again, we get back to you've got to be patient. Peter Lynch, who also was referred to today, wrote a very famous book called One Up on Wall Street. And then there's something called the Essays of Warren Buffett. This is the most requested book for him to autograph at his annual meeting in Omaha, Nebraska. So we would recommend this. And then the other thing is Google and read Warren Buffett's annual letter to shareholders. Wit and wisdom, straight talk. It's very difficult to read that letter and not, at a minimum, feel great about investing in stocks, investing in capitalism, investing in America, all of those things. So we think this is a great list, and we hope that you take advantage of it. All right, let's take a look at the rest of 2025. We think it looks strong. I know that's not what the media is saying. I was with a client yesterday on Zoom, and they said, how can the market be up 10%, 11%, when everything I hear on the news is negative? Well, there you go. Everything you hear on the news, here in news, is negative. Well, I mean, there we go. Yeah, there's always going to be negative things in the economy. As a matter of fact, just recently, I think it was this week, there was a revision in the number of jobs, a downward revision of over 900,000. That's a big number. The new jobs created in the last couple of months has been well under 100,000. So certainly there is slowing, but slowing is normal in any cycle. The unemployment rate, however, is quite low, 4.2%. So when we look at things, the current economy does look strong. These bullet points are all up here together, so we'll kind of go through them. Current economy is reasonably strong. So we just had a GDP readout of 3% for the 3.3% for the second quarter. That's a very strong reading. Now, most economists, and again, this is where they make predictions. Most economists are expecting for the third and fourth quarters of this year for that to fall all the way down to maybe 1.5%. But that's far from a recession. Very, very important. The tariff fear is subsiding. We've seen that. More of these deals are being made. We're not going to be worrying about those gigantic tariffs that Trump was threatening back on April 2nd. You're looking at between 10 and 15% for most of our largest trading partners. So the damage is limited. And look, we know that those countries are not paying those tariffs. Then they might be paying a small part of it in that they reduce the price of their product to us as an inducement to buy it. That might be a third of it. The other 2/3 of it are going to be paid for by either the corporation, the company that's buying it, and then of course the consumer that's going to have to pay a little bit more for that product. But overall, the fear of tariffs is subsiding, and I think the evidentiary proof, is that the market is up 11%. They're excited that we're not going to have to worry about those giant tariffs that were threatened. You've got a Fed now that's very likely going to lower rates. You had an inflation report today. We're going to talk about that down here a little bit. That was much lower than expected. Something called the producer price index. That's at the wholesale level. It's what they're paying to make things or to buy things that they ultimately are going to sell. That came in way lower than expected. By now, you would have expected, as a result of the tariffs, some more significant impact, and we're just not seeing it. Oil is down and has stayed low. As we mentioned, the Fed's going to likely lower rates next month. probably do it again at least in December, and probably for the first half of next year, 2 or 3 times. We're going to go from a 4.25 down to probably a 3.25 or so rate by the end of next year. And that will be extremely stimulative. How is it possible that these countries that have been threatened and intimidated by very large tariffs for the better part of this year, how is it possible their stock markets could be doing double what our stock market is doing? Well, the answer is really simple. It's that their Federal Reserve banks in the Euro Union, as well as in greater parts of Asia and other areas of the world, their Feds have been lowering for more than a year. Our Fed has been the outlier. So very, very interesting. So as our Fed lowers, then our stock market is going to feel the benefits of that as we go on. The extension of the current tax law with 100% expensing is absolutely stimulative. We know this administration wants a lower regulatory environment. And of course, all of the domestic and foreign investment has now ballooned up to $11.1 trillion. We are keeping a close eye on that for you, by the way. That's pledged money. Much of these projects have already broken ground, but we're going to track that through sources that we trust to make sure that these are real numbers. If they are, I would even argue if it's half this much, that is significant stimulus. Very hard to have a recession when you have a low unemployment rate, when you have a Fed lowering rates, and you've got the kind of stimulus that the new tax law gives businesses to buy things and expense 100% of it in the first year. And then you've got all these other private dollars flowing into the United States of America, both domestically and from overseas. Very difficult to have a recession. In fact, it argues for the market going up. This next slide is one that we've shared many times as well. What it is U.S. corporate profits. They're in purple. You can see U.S. corporate profits. The trend over the last 10 years is up. You know, there was the big drop during COVID that was understood, but it recovered right away and it's continued to move up. Overlaid on that is the S&P 500. Do you see a similarity? I think you do. Stock prices follow corporate profits. So if there was one thing and one thing only that you looked at, this would be the thing to look at. As corporate profits start to fall, there are other underlying issues that you would look at, but that would be an indicator to understand what's going on in the market. Wouldn't be necessarily a giant reason to sell all your stocks. Again, we want to be patient investors. The way you make the most in your stock allocation is by being patient and by staying in the market. Remember 1982 to 1999? We all want that 16% annual rate of return, but we've got to have the patience to get there. And that's what this helps us to do. And so, you know, when I share this with clients, my question is look, what should you be looking at? Well, you know, will corporate profits, is it reasonable to expect corporate profits to continue to rise? Well, we'll go right back to the slide that I just shared. All of those things are stimulative to corporate profits, promote corporate profits. So we think we're in a very, very, very good place there. All right, let's take a look at market returns. Usually we do this first, but we thought we'd do this last. Again, it's hard to believe, almost 12% S&P 500. Look at that international index that I referred to, double what the United States has done. Why? Their Feds have been lowering rates. Okay. Our Fed is just going to start to lower rates again. I don't think that's a coincidence that they've done so well, and I think we're going to benefit from that. Probably the biggest beneficiary will be this index, the Russell 2000 Small Company Index. It's only up 8%, although that's a good number. I think anybody would love 8%, but it should be up significantly more than the S&P 500. And if history is any guide, when the Fed starts cutting over the next several months, that will be very stimulative of this. But take a look at this index here too, the bond index, which was up a measly 1.25% last year. having a fantastic year. This, I believe, also the other big beneficiary to the Fed lowering rates, and those are bonds. And of course, we've done our work in making sure that you have the best of the best in the bond market, the best of the best in stocks, and alternatives and international. We feel really, really good about that. All right. So just in closing, IWA beyond just investments, we're really encouraging you to get your financial plan done. I know most of you have, and for those of you that don't, we really encourage you to know where you are. A financial plan helps you know where you are. And that's why we have these 4 points here. It involves estate planning, charitable giving. If you own a business, we're able to help there, as well as just on an individual basis, doing tax planning so that your dreams as a result of a plan result in your enjoyment of your life, not only today, but obviously throughout your retirement. And of course, we'll be here always to help you through the very, very difficult times. All right, guys. All right. Once again, thank you very much for joining in this afternoon. We value you so much. We hope you enjoyed this content. And if you have any feedback, please send me a note and let me know what you liked, didn't like, or if you have a topic that you would like to have us talk about in a future town hall. So please do that. And until next time, stay safe, be patient. And if you have any problems with your emotions, give me a call. We'll talk to you next month. Bye-bye now.